Hey everyone, welcome to Property Finance with Lee and part 8 of our Ultimate First Home Buyers Guide series. In today's video, we're going to talk about different mortgage options. If you're new to the channel, I'm a licensed mortgage broker with an extensive property investment background. I talk all things property financing and investing. Don't forget to subscribe and turn on notifications so you don't miss out on the next part of the series. Let's start. The first characteristic of any loan is its purpose. For property loans, there's owner-occupier loans and investor loans. The difference between the two is that an owner-occupier loan is a mortgage designed for individuals who intend to reside in the property they are purchasing, making it their primary residence. Owner-occupier loans typically come with more favourable interest rates when compared to investor loans. Next, let's talk about interest rate types, fixed and variable. A fixed rate is simple to understand. Essentially, it's a loan where the interest rate remains constant throughout the loan's fixed term. This means that your monthly repayments will stay the same for the duration of the fixed term, regardless of what happens with interest rates. The maximum fixed rate periods typically offered are 5 years and below. Obviously, the main advantage of a fixed rate mortgage is its predictability. With a fixed rate interest rate, you can easily plan and budget your finances, as you'll know exactly what your monthly payments will be. This is particularly beneficial if you have a tight budget or prefer stability in your monthly mortgage payments. The main reason people take out a fixed rate mortgage is that it can shield you from rising interest rates. If the market interest rates increase, your monthly payments won't change during the fixed term, giving you peace of mind, especially during economic climates like today, where everyone with a mortgage is on the edge of their seats, hoping the RBA doesn't raise rates. Despite these advantages, there are also some cons to consider before opting for a fixed rate mortgage. The most notable drawback of a fixed rate mortgage is that the interest rate is often higher than that of a variable rate mortgage. This is because the lender assumes more risk by guaranteeing a fixed interest rate regardless of the borrowing cost to the lender in the future. Another downside of a fixed rate mortgage is its lack of flexibility compared to a variable rate mortgage. If market interest rates drop, you won't benefit from lower rates unless you refinance your mortgage, which can be costly. Moreover, most fixed rate mortgages often come with prepayment penalties or fees charged by the lender if you pay off the mortgage early or make extra payments. So, how is a variable rate different? The difference is the interest rate fluctuates throughout the loan's term. The interest rate is typically correlated to the RBA's cash rate, which is the bank's borrowing cost. In theory, when the cash rate drops, so should your applicable interest rate, and vice versa. The primary benefit of a variable rate mortgage is flexibility. Many variable rate mortgages allow you to make additional payments or pay off the loan early without incurring penalties. Some variable rate mortgages also allow you to have an offset account connected to the loan, which means you will save on paying interest proportionate to the savings in the account. Another obvious advantage is the potential for lower interest rates. If market interest rates decrease, your monthly payments will decrease, and you'll pay less interest over the life of the loan. Of course, there are cons of a variable rate mortgage also. The most significant risk of a variable rate mortgage is the uncertainty it presents. Your monthly payments can increase considerably if market interest rates rise, making it challenging to budget and plan your finances. Financial stress during rate rises cannot be underestimated either. If we look at the high inflationary environment we find ourselves in today, not only has the cost of living gone up, but those of us with variable mortgages have been hit hard with 12 consecutive rate rises as well. Our interest rates have tripled. This can lead to financial stress, especially if you're already on a tight budget or have other financial commitments. Fluctuating repayments can make it more challenging to manage your finances, save money, or invest in other areas. A lot of people consider fixing interest rates solely as a strategy to beat the banks at their own game, locking in rates they believe will rise. The reality is that, historically, banks have done a great job in safeguarding their profits with fixed rate mortgages. When examining a typical 10-year span and comparing the cost of variable and fixed rate mortgages, it becomes evident that fixed rate mortgages over this duration have been on average more expensive for borrowers than variable rate mortgages. The main reason why you would fix your rate is to provide certainty in your decision making, to be able to budget around what will most likely be your biggest expense. Now you may be wondering, do I really need to choose one or the other? The answer is no. There is a third option, a split home loan. A split home loan is when you divide your loan into multiple parts, assigning a portion of the loan to have a fixed interest rate and the remainder to have a variable interest rate. This allows you to enjoy the benefits of both fixed rate and variable rate mortgages simultaneously. So this can make more sense. Let's say you have a $500,000 home loan, and after considering the types of home loans available, you decide on a 50-50 split. Your home loan would then be divided into two loans. A fixed interest rate would be charged on $250,000 and the remaining $250,000 would have a variable interest rate. There are advantages to both fixed and variable rate home loans. With a split loan, you can take advantage of the features and negate the downsides offered by both to a certain degree. An obvious one is, while a portion of your home loan is fixed, 50% of the repayments will remain the same if interest rates rise. With the variable portion of your mortgage, you'd have the flexibility to make additional repayments. This could mean paying off that portion of your home loan faster, as well as having access to benefits such as a redraw and an offset account, depending on the type of variable rate home loan you choose. You may also benefit from an interest rate drop on the variable portion, although your repayments would increase if the interest rate rises. The split percentage between the fixed and variable portions doesn't have to be 50-50 either. You can have a 70-30 split, for example, allowing you to tailor the mortgage to suit your appetite for risk and budget. The most common repayment cycle for a home loan is monthly, but you can also have your home loan repayments come out fortnightly or even weekly. By opting for more frequent repayments, you will save on interest over the course of the loan. Now, before we wrap this up, just quickly, I want to talk about interest-only terms. When you're purchasing your first home or even an investment, you may have stressed yourself a little financially. Perhaps there's something you want to renovate or something that needs fixing. What you can do is, instead of making principal repayments straight away, you can opt for an interest-only period to reduce the monthly cost of the loan. Of course, during an interest-only period, you aren't making principal repayments, so you're not working towards paying down your loan. And also, interest-only loans tend to have a more expensive interest rate. If you found this video helpful, please give it a thumbs up and don't forget to subscribe to catch the next part of the series. Also, like I've mentioned in previous videos, if you found a property and want a free property report, follow the link in the description, provide us with the address and we'll email it to you. Thank you for joining me today. Catch you next time.